Welcome to Iron Financial. We're the only show out there dedicated to putting market narratives under extreme stress, all to help you forge a stronger, more durable portfolio. I'm your lead analyst. Today, we are putting Netflix right under the microscope. The company just dropped its Q1 2026 earnings report, and I mean, on the surface, this thing looks like a fortress of profitability. But the market's reaction, well, it tells a completely different story, and it's revealed a paradox that we have to break down piece by piece.
And I'm your market skeptic. The lead analyst is absolutely right. The stock took a serious nosedive after the announcement, and honestly, that's the kind of disconnect that we live for. You see, when a company posts these incredible blockbuster numbers, but the investors are sprinting for the exits, it means the market sees cracks in the foundation that you're just not going to find in the headlines. So our job today is to find out if those cracks are just on the surface or if they run right through the core of this entire business. We're going to figure out if this is a structurally sound investment or just a trap waiting to spring.
All right, let's get into it. Here's our inspection plan for today. We're going to kick things off with that earnings paradox and then dive right into the revenue engine. Then my colleague here is going to stress test their strategy. After that, we're inspecting the balance sheet, the very foundation, and the big leadership transition. And finally, we deliver what you came for, the iron verdict. Let's get to work.
Okay, section 1. Let's start with the polish, right? The pristine, shiny surface that Netflix presented to the world. And let me be clear, you cannot argue with these numbers. They didn't just beat expectations, they absolutely obliterated them. This is the kind of report that 99 times out of 100 should have sent the stock soaring into the stratosphere. I mean, just look at the sheer force of this growth. Revenue is up over 16% to $12.25 billion. Operating income climbing a really solid 18%. But the real story, the one that should have blown the doors off, is the bottom line. Net income exploded by nearly 83% to over $5 billion. And diluted earnings per share, it followed right along, up a staggering 86%. Look, from a purely financial performance standpoint, this quarter was a masterclass in execution. They told the market they were going to deliver, and then they over-delivered in a big way.
And that's exactly where I have to step in. Because you have to remember the market is a forward-looking machine. It doesn't give out rewards for past performance. It prices in future risk. These numbers are fantastic, absolutely spectacular, but they're in the rearview mirror now. That 4.78% after-hours drop, that's the market screaming at the top of its lungs that it does not believe this strength is durable. It's signaling that there's something hiding in the company's guidance, or its strategy, or maybe its internal dynamics that represents a future weakness. This is the first structural flaw we're seeing, and believe me, it demands a much, much deeper inspection.
That's actually the perfect lead-in to where we're going next. Section 2, forging the revenue engine. You know, to really understand the market's fear, we first have to appreciate the sheer scale of the machine we're talking about. Netflix isn't just a media company anymore. It is a global monetization engine, and management is projecting a whole lot of confidence that they can keep it running at full throttle. So here's the crucial point. This isn't just about one good quarter. Management held firm on its full-year revenue guidance. They're projecting they'll bring in somewhere between $50.7 and $51.7 billion for 2026. That represents 12 to 14% year-over-year growth. They are building a financial juggernaut, and they're sending a clear signal to Wall Street that the growth trajectory is fully intact. This really is the core of the bull case, a powerful, predictable, and absolutely massive revenue-generating operation.
So how are they forging all this growth? Well, it's basically a three-pronged assault. First, they continue to see what they call healthy membership growth, okay? Second, they're implementing strategic price hikes, which they claim have gone well, saying it reflects the value they provide. And third, and you really need to pay attention to this one because this is the key accelerator, is the advertising business. Each one of these pillars is designed to be a heavy, load-bearing component of their $50 billion structure. And this chart illustrates the advertising story perfectly. This is the high-octane fuel being pumped directly into the engine. They are on track to double their ad revenue this year, aiming for approximately $3 billion. That's a 100% year-over-year growth rate. They've expanded their advertiser base by over 70% to more than 4,000 clients. And get this, in their ad-supported countries, over 60% of all new signups in the first quarter were for the ad plan. So you see, this isn't some side project anymore. It's rapidly becoming a core central part of their entire monetization strategy.
And here's my problem with all of that. Is this really building a bigger, stronger ship? Or are they just rearranging the deck chairs and finding more creative ways to charge the passengers who are already on board? Look,
Price hikes and pushing users toward ad-supported tiers, yeah, that can boost your revenue in the short term, but that is not the same as fundamental, durable expansion. How much of this is truly new growth from capturing more of the market versus just squeezing every last drop from a user base that might be getting close to its ceiling? Squeezing more revenue per user isn't a sign of strength if it comes at the cost of user satisfaction or if it leads to churn down the line. We have to question the quality of this revenue, not just the quantity.
Exactly. And that takes us straight into section 3, where we are going to put the company's strategic blueprint under some direct and serious pressure. I'm going to look for the potential failure points here. Management, they present this clear 3-pillar strategy, but every single blueprint has a weak spot. So is it competitive pressure? Is it flawed execution? Or is it a simple lack of vision? Let's find out. First, let's lay out the official plan. This is the blueprint as Netflix presents it. Pillar 1 is all about content and engagement, delivering more value through shows, movies, live events, and even games. Pillar 2 is about technology, using things like AI and a better user experience to keep people glued to the platform. And Pillar 3 is what we were just talking about, monetization through pricing and ads. On paper, it looks good. It's a robust, self-reinforcing loop. More value justifies higher prices, attracts more ad dollars, and then that money gets reinvested into creating even more value. And to be fair to management, their execution on Pillar 1 is pretty undeniable. They aren't just talking about it. Bridgerton's 4th season pulled in a massive 94 million views. They're also making moves into regional live events with incredible success. I mean, the World Baseball Classic wasn't just some niche sports event. It became their most watched program ever in Japan, and it directly led to their single largest day of signups in that country's history. That isn't just content. That's a powerful strategic tool for subscriber acquisition. And on the technology front, they're definitely making some smart, forward-looking moves. The acquisition of Interpositive is a perfect example. This isn't just about buzzwords like AI. No, they're buying technology that was built by filmmakers for filmmakers to integrate generative AI directly into the creative process. This has the potential to make their single biggest expense, content creation, way more efficient and more impactful. It's a clear, smart investment in that second pillar. Okay, but let's use their own words to make a little pivot here. Extraordinarily dynamic and competitive. They admit it themselves. Staying focused and improving faster sounds great, but that's not a strategy. That's a necessity for survival. The real question is whether this 3-pillar plan is actually enough to build a real defensive moat against some of the largest, most well-capitalized companies on the planet, all of whom are coming for the exact same pool of user attention and dollars. I mean, just look at this battlefield. This isn't just about other streaming services anymore. Netflix themselves identify their competition as Alphabet, Amazon, Apple, Disney, and Comcast. But they also list Meta, Roblox, and TikTok. They're not just competing for your subscription dollars, they are in a fight for every single second of your screen time against the most effective attention merchants in human history. Their strategy has to be strong enough to win not just against another movie studio, but against the endless scroll of social media and the immersive worlds of gaming. That is a war on multiple fronts. And that brings us to execution. They talk a good game about M&A, but what about the biggest deal they ever attempted? Walking away from the Warner Bros. Acquisition was framed as discipline. On the earnings call, Ted Sarandos said they tested their discipline and were willing to walk away when the price wasn't right. Okay, that's the official story. But was it really discipline? Or was it a sign that when it came time to execute a transformative, company-defining merger, they just couldn't get it over the line? It raises serious questions about their ability to perform the kind of heavy lifting that's required to make big, strategic moves in this hyper-competitive space. To me, it looks less like a test of strength and more like a failure to complete the lift. A fair point. Let's pivot from the strategy back to the bedrock of any company, the numbers. Section 4, the balance sheet foundation. Now here, we move away from all the hypotheticals and into the hard, cold cash. And I'm going to argue that no matter what the strategic questions are, the financial foundation of this company is not just solid, it's reinforced steel. Just look at this number, $5.1 billion in free cash flow for the first quarter. That's cash generated after all expenses and all investments. This is not some accounting magic. It's real money flooding into the company's coffers, and it is nearly double the $2.7 billion they generated in the same quarter last year. This is a cash-generating machine operating at an absolutely incredible level of efficiency. This kind of financial power gives them the ability to weather any storm and fund any strategic initiative they choose. Period. And they are deploying that cash with serious discipline. This is their capital allocation strategy. First, They reinvest in the business, both organically and through selective M&A, like that Interpositive deal. Second, they maintain a fortress-like balance sheet, ending the quarter with over $12 billion in cash. And third, they return the excess cash to shareholders. In Q1 alone, they bought back $1.3 billion of their own stock. This is the blueprint of a mature, confident, and very shareholder-friendly company.
Whoa, hold on. Shareholder-friendly? If the company is so confident, so flush with cash, and if the future is so bright, then can you please explain to me why the smart money, the people who know the business better than anyone else in the world, is selling? Look at this data. Over the last 6 months, there have been 102 open market sales by company insiders, and the number of purchases? 0. A big fat 0. That's not a yellow flag, my friend. That is a blaring 5-alarm red flag. Insiders have sold over 2.4 million shares, cashing out for more than $300 million. You simply cannot talk about a shareholder-friendly company when the most informed shareholders are all heading for the door.
And let's just drill down on the most important insider of them all, the visionary co-founder Reed Hastings. He alone accounts for the vast majority of that selling. In the last 6 months, he has unloaded over 2 million shares for an estimated $237 million. So while the company's out there buying back shares, the founder himself is distributing his own shares to the market at an absolutely incredible clip. What kind of message does that send? To me, it suggests a profound lack of faith in the company's future growth prospects from the man who built the entire structure from the ground up.
That's a powerful point, and it leads us directly into our 5th section, passing the torch. The departure of a visionary founder is a seismic event for any company, and Reed Hastings isn't just selling shares, he's stepping away from the board entirely. The company, of course, is doing its best to frame this as a smooth, well-planned evolution. You can see it right there in their official communications. Co-CEO Ted Sarandos calls him a singular source of inspiration and a true history maker. The messaging is all about celebrating his legacy, portraying this as a seamless, amicable transition of power. They want investors to see this not as an ending, but as the natural next chapter in the company's story, with his handpicked successors, Ted Sarandos and Greg Peters, firmly in control of the reins. But a founder isn't just another executive. They are the keeper of the flame, the source of the company's entire DNA. Hastings built Netflix by making a series of massive, gutsy, industry-shattering bets, from DVDs by mail to streaming to original content. Now, with him completely removed from governance, who is left to champion that next wave of disruptive, uncomfortable, paradigm-shifting innovation? I mean, the current leadership team, they're excellent operators, no doubt, but are they visionaries? Or will Netflix now just become a mature, slower-moving incumbent focused on optimizing the empire Hastings built rather than building a new one? His departure creates a massive vacuum at the very heart of the company's innovative culture. Which brings us to our final section, the iron verdict. We've examined the pristine earnings report, the powerful revenue engine, the strategic blueprint, the solid foundation, and yes, the cracks that are forming from competition, from insider selling, and from a potential leadership vacuum. So now it's time. It's time to weigh all the evidence and determine if this post-earnings stock drop represents a real buying opportunity or a very well-laid trap. Okay, let's summarize this whole thing. The bull case, the argument for the strength of the foundation, is very compelling. You've got explosive revenue and profit growth. You have a fire hose of free cash flow. There's a clear multi-pillar strategy that is, by all accounts, being executed well. And you have that ad business as a powerful new growth accelerator. But the bear case, the evidence of cracks in that foundation, is just as serious. The competitive landscape is brutal, and it's expanding way beyond just streaming. The sheer volume of insider selling is deeply, deeply concerning. The failed Warner Bros. Deal raises serious questions about their M&A capabilities. And of course, the visionary founder who navigated every single major pivot in the company's history is gone.
So here is our iron verdict. Netflix is not a crumbling structure. Let's be clear on that. The financial foundation is made of solid concrete, and it's generating billions upon billions in cash. But the stress test has revealed significant, undeniable cracks. The market's negative reaction wasn't irrational. It was pricing in the very real risks of intense competition and the deep uncertainty that comes with the end of the founder's era. This is a powerful, profitable incumbent, but it is now facing the strongest headwinds in its entire history. Investors who choose to ignore these stress fractures do so at their own peril.
And that leaves us with the ultimate question, doesn't it? The company built its entire empire by being the nimble disruptor, the underdog that outmaneuvered giants like Blockbuster and traditional media. But now, It is the giant, a $50 billion a year giant. In an industry where the next major threat can come from a social media app or a gaming platform, is all that scale an asset that provides a defensive moat, or is it a liability that just slows them down? Can a fortress also become a prison? That is the question investors have to answer for themselves. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.